Hello friends. Starting this year, there is a growing list of taxes that older Americans are simply no longer paying, and most seniors have no idea how many of them apply to their own situation. Some of these changes took effect quietly at the start of 2026. Some are brand new this year, and some are worth thousands of dollars a year to the right person, sitting unclaimed because nobody ever sat down and explained the full list. Today I am going to give you that full list, the taxes seniors are no longer paying in 2026, who qualifies for each, and the states where your retirement income is now completely tax-free. Let me be honest with you up front. Not every item applies to every senior, and where you live changes everything. This is one of the biggest shifts in retiree taxes in a generation, and it is happening quietly, one state and one rule at a time. So stay with me, because by the end, you will know exactly which of these you should already be keeping in your own pocket, starting with the one that touches nearly every senior in the country. Before we get into it, subscribe to this channel right now and turn on the bell. Tax rules for seniors are changing faster in 2026 than they have in years, state by state, and nobody sends you a personal letter when a tax you have paid your whole life quietly disappears. They change the rule and expect you to already know it. Subscribe now and let's get into it. Number 1 on the list, and this is the one that touches nearly every senior in America: federal tax on your Social Security benefits. For decades, a large share of retirees paid federal income tax on part of their Social Security checks. That has changed dramatically this year. Because of the new senior deduction passed in 2025, an extra $6,000 deduction for anyone 65 or older, stacked on top of the regular standard deduction, the amount of your income that actually gets taxed drops sharply for most retirees. The result? By some estimates, close to 9 out of 10 seniors will owe no federal tax at all on their Social Security this year, up from a little over half in years past. Now, I want to be straight with you because there is a lot of misleading talk about this. The tax on Social Security was not repealed. The law did not erase it from the books. What happened is that the deduction grew large enough that for most seniors, there is no longer any taxable income left for that tax to reach. To put it in plain terms, a single senior living on $22,000 of Social Security plus a small IRA withdrawal may now have a standard deduction and senior deductions so large that their taxable income lands at zero, meaning not a dollar of federal income tax and not a dollar owed on their Social Security. A few years ago, that same person might have been writing the IRS a check. If your income is modest, Social Security plus a small pension or IRA withdrawal, there is a very good chance you now owe zero federal income tax. But if your income is higher, that deduction phases out above $75,000 for a single filer and $150,000 for a couple, and you may still owe something. The move for you this summer is simple. Before you make your next estimated tax payment, check whether you even still owe federal tax this year, because a lot of seniors are still paying as if nothing changed. Number 2, state tax on your Social Security. And this is where the map matters more than almost anything else. Here is the good news, and it is bigger than most people realize. As of 2026, 42 states plus the District of Columbia do not tax Social Security benefits at all. That means in the large majority of the country, your Social Security check is completely free of state income tax. And the list of states that still tax it keeps getting shorter. West Virginia finished phasing out its tax on Social Security this year. As of January 1st, 2026, benefits are 100% exempt there, no matter your income. That follows Nebraska, which finished in 2025, and Missouri and Kansas, which stopped back in 2024. So which states still tax it? As of 2026, there are just 8: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. And even in most of those 8, there are generous income exemptions. So a retiree with a modest income often pays little or nothing. If you live in one of those 8 states, this is worth a phone call to your state's Department of Revenue or a careful look at your last return, because you may qualify for an exemption you are not currently taking. To put a real number on it, a couple collecting $3,500 a month in Social Security, living in a state that taxes those benefits at around 5%, could be handing their states well over $2,000 a year. Money a retiree one state line away keeps entirely. And if you live in any of the other 42 states, your Social Security is simply not taxed by your state. Full stop. Number 3. State tax on your pension and your retirement account withdrawals, because Social Security is only part of the picture. 9 states have no state income tax whatsoever, which means your pension, your 401k and IRA withdrawals, your annuity income, all of it escapes state tax entirely. Those 9 states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. Beyond those, several states with an income tax choose to exempt retirement income anyway. Illinois, for example, does not tax retirement income at all. Not pensions, not Social Security, not IRA withdrawals. Iowa exempts retirement income for residents 55 and older. Mississippi and Pennsylvania broadly exempt retirement income as well. And here is a brand new one for 2026 that a lot of Michigan retirees are going to miss. Michigan just completed a multi-year phase-out of its retirement income tax. Starting with the 2026 tax year, most pension, 401k and IRA income is exempt up to roughly $67,000 for a single filer and $135,000 for a couple. If you are a Michigan retiree who paid state tax on your pension last year, you may not owe it this year. And if your withholding has not been updated, you could be overpaying every single month without realizing it. Check the retirement exemption for your own state, because the difference between a state that taxes retirement income and one that does not can be $3,000 to $10,000 a year. Think about what that means over a full retirement. $10,000 a year across 20 years is $200,000, enough to change where and how you live. Number 4. And this one is less a single item and more a warning to keep watching, because the list is still moving. Over just the last 2 years, a wave of states have stopped taxing Social Security. Colorado in 2024, Kansas and Missouri in 2024, Nebraska in 2025, and now West Virginia completing its phase-out in 2026. No state in recent memory has added a new tax on Social Security. The movement is entirely in one direction, toward exemption. Some of the 8 remaining states have active repeal proposals moving through their legislatures right now, which is exactly why this list may look different a year from now. What that means for you is practical. If you live in one of the 8 states that still tax benefits, there may be a proposal in your state legislature right now to change that, and it is worth keeping an eye on. And if you moved recently, or you are even thinking about where to spend your retirement, the state you choose can quietly be worth thousands of dollars a year in taxes you either keep paying or never pay again. This is not a small footnote. For a couple living mostly on Social Security and a pension, the wrong state versus the right state can be the difference of a car payment every single month. Number 5 on the list, and this one does not show up on your federal or state income tax return at all, but for many seniors it is the single biggest bill of the year, your property tax. This one is not a national rule, it is handled county by county, but almost every state offers some form of property tax relief for seniors that a huge number of eligible homeowners never claim. Depending on where you live, that can be a homestead exemption that lowers the taxable value of your home, a senior freeze that locks your assessment so your bill stops climbing as your home's value rises, or a deferral that lets you postpone the tax entirely. And unlike income tax, property tax does not care whether you have much income at all. A retiree on a fixed Social Security check can watch their property tax bill climb year after year as their home's assessed value rises, which is exactly what a senior freeze is built to stop. These programs almost never apply automatically. You usually have to file for them, often once and often by a specific deadline your county sets. So the move this summer is to call your county assessor's office or check their website and ask one simple question. What property tax relief is available for homeowners my age, and have I already applied for it? A single senior freeze can save hundreds or even thousands of dollars a year for as long as you own your home. And an enormous number of seniors who qualify simply never fill out the form. So here is the full list. 1. Most seniors now owe no federal tax on their Social Security this year, thanks to the new $6,000 deduction, so check whether you still owe anything before your next payment. 2. 42 states plus DC do not tax Social Security. West Virginia just joined them this year, and only 8 still do, and even most of those exempt modest incomes. 3. 9 states tax no income at all, and states like Illinois, Iowa, Mississippi, Pennsylvania, and now Michigan exempt retirement income, so check whether your pension is still being taxed. 4. The trend is moving fast toward exemption, so watch your own state and weigh it seriously if you ever relocate. And 5. Call your county about senior property tax relief, because a freeze or exemption you have to apply for could turn out to be the biggest saving of all. Subscribe, turn on the bell, and share this with someone 65 or older so they can check their own list this summer and stop paying what they no longer owe.